Well, thank you for joining us today. We'll get started. Welcome to eOption's webinar. We're so happy that you can join us today. My name is Gina Bocayas, and I'm on the management team at eOption. And I'd like to welcome you today to eOption's webinar entitled How to Use Options to Generate Positive Cash Flow. And I'm very pleased to introduce our speaker, Ken Keating, at the Options Industry Council. And to tell you briefly about Ken, he's been trading and analyzing options for over 25 years. He's a senior investor services specialist and certified instructor with the Options Industry Council, or more commonly called OIC. He began his career at Group 1 Trading on the floor of the Pacific Stock Exchange and later transitioned to the floor of the Chicago Board Options Exchange. And he's held many positions in the industry. He's been a floor market maker, a floor specialist, a risk manager, and off-floor prop trader. He later worked at Peak 6 Capital Management as an options portfolio manager, as well as trading for himself at Sumo Capital. After a successful trading career, Ken transitioned to Oxford Intelligence Partners, analyzing equity and derivative flows for publicly listed companies. And again, the topic is how to use options to generate positive cash flow. And if you have any questions, please feel free to type them in at any time during the webinar while Ken is speaking. You'll see a box at the bottom of the screen entitled Q&A. So please feel free to click on that and Ken will address your questions. The plan is the webinar lasts about 45 to 50 minutes, and then Ken will address the questions at the end for about another 10 or 15 minutes. So without further ado, we'll get started on eOption's webinar, How to Use Options to Generate Positive Cash Flow, and I'll let Ken take it from here. Thank you.
Well, thank you, Gina, and welcome everybody, and thank you for taking time out of your busy schedules to be with us here today for our presentation on how to use options to generate positive cash flow. So before we get started, I have to do a little house cleaning for all the lawyers at the OCC. I do have to mention that options do involve risks and are not suitable for everyone. All individuals should read and understand the risk disclosure document, characteristics and risks of standardized options. You can obtain a copy either through your broker, or you can visit us at optionseducation.org, or you can shoot us an email at options@theocc.com, and we would be happy to send you a copy free of charge. To simplify the computations and the examples today, we are purposely leaving out commissions, fees, margin interest, and taxes to keep things simple. And lastly, any strategies discussed today, including examples of securities and price data, are strictly for illustrative and educational purposes and should not be construed as an endorsement, recommendation, or solicitation to buy securities on behalf of OIC. All right. So with that out of the way, just to give you a little background on Options Industry Council, or the OIC. We are the education arm of the Options Clearing Corporation. The Options Clearing Corporation is the world's largest clearing house for equity derivatives. We are the education arm, and we are fully funded by the OCC. So we really have no agenda other than offering best-in-class, free, and unbiased professional options education. We do that primarily through our website at optionseducation.org. There you'll find a ton of free resources, including an online course, podcasts, videos, and webinars. We're actually in the process of revamping our learning management system. So sometime in later 2020, we're going to have a more comprehensive and robust online options curriculum, almost like a course that you can take that'll guide you from beginning, intermediate to advanced. We are also reintroducing an options simulator, which you'll be able to paper trade actual securities and monitor them in real time without risking any money, which is something that investors have been asking about, something that we used to have but we discontinued, but we will be reintroducing that with the new learning management system going forward sometime in later 2020. The pride and joy of the OIC is our investor services desk, and you can reach us at options@theocc.com with any and all of your options-related questions. We are there Monday through Friday from 8 a.m. to 4 p.m. Central Standard Time. And between all of us, we were talking the other day, I think we have over 80 years of options trading and risk management experience between all of us on the desk. So certainly take advantage of that service that we offer. Turnaround on questions is fairly quickly. Most people get their questions answered same day. All right, so here's a look at the U.S. listed options exchanges. There are 5 main parent exchanges: the CBOE, the NASDAQ, the BOX, the NYSE, and MIAX options. These are where your orders get routed to, depending on the NBBO or National Best Bid or Offer, where they get executed. There are 16 sub-exchanges, so many of these exchanges offer multiple platforms. And I'm not going to get into the difference between all the different platforms, but you just have to know they exist, and there are 16 completely different exchanges that exist. So here's the annual options volume statistics going back to the very beginning. Options started in 1973 on the CBOE, and as you can see, the trajectory and growth in the options business industry has been phenomenal. 2018 was a record year for OCC, where we cleared and settled over 5.2 billion contracts. 2019, we cleared and settled just shy of 5 billion contracts. And 2020 is already shaping up to be a pretty impressive year. January was actually our largest January ever, where we cleared and settled 522 million contracts, which was a record. And that was due to the unprecedented volatility we've seen lately in the markets. All right, so let's get started. So here's today's presentation outline. We are going to be focusing on income generating strategies. We are going to be looking at 3 in particular. We are going to be looking at the covered call strategy. Then we're going to get into the cash secured put. And finally, we're going to finish up and we're going to look at the covered combo or covered combination strategy. So picking the right strategy is always key. The beauty of options is whether you are bullish, bearish, or neutral, there is a strategy for your outlook. Today, we're going to be focusing on income strategies. So the strategies we are going to look at are going to be if we are neutral to moderately bullish on a particular security or index. So 2 things that investors always need to ask themselves before they put on an options trade is there is your motivation and there is your forecast. So in looking at the option strategies we are going to talk about today, the motivation is we are looking to create an additional amount of income over and above near-term stock appreciation plus the dividends. We are looking to add a little risk protection on the downside, as well as in some cases, potentially buying additional shares on a pullback in the stock. So at any given time, we can have a bullish, bearish, or neutral outlook. Implied volatility, an increase or decrease, will always have an impact on our option strategy no matter what happens. So I'm not actually going to get into implied volatility. Implied volatility actually is the most misunderstood aspects of options trading. And I would highly recommend anybody who's trading options to familiarize yourself with implied volatility and what exactly it is. Just to give you a simple breakdown, mathematically, implied volatility is the annualized standard deviation of a stock's daily price changes. Okay, so to say that in English, implied volatility is simply the forward-looking measure of how far traders expect the underlier to move. So it's a measure of the volatileness of a security going forward. Something to keep in mind, only options have implied volatility. Stocks do not have implied volatility. And it's expressed as a percentage, in a pricing model. So when you hear the pundits on TV talk about vol or implied vol, and vol's bid or vol's expensive, all that means is that volatility is going higher. When implied volatility goes up, that just means option prices are getting more expensive. And when implied volatility is going lower, option prices are getting cheaper and cheaper. So last Friday, as you can recall, when the market was down 600 plus points, implied volatility skyrocketed because you had a lot of people racing to buy protection on their portfolios, and they're bidding up out of the money puts, they're bidding up calls, however they're playing it, implied volatility, prices are getting bid up. So implied volatility in that instance is going up. So that's pretty much, like I said, I could carry on for hours about implied volatility, but just understand that that's one aspect of the options trading that is really crucial that you understand, is implied volatility. For outlook, at any given time, we have a short-term and long-term view of the stock. And we also have events that impact our outlook. So we have things like earnings, FDA announcements, retail sales, Fed announcements. All these are going to shape our outlook for our shares and what positions we will look to put on. All right, so let's look at the very first strategy. The very first strategy we are going to cover is the covered call or buy right position. And this is probably a strategy that many of you have already implemented over your trading career. It's one of the most popular option strategies, especially in a low rate investment environment like we have right now. A covered call simply is the purchase of 100 shares of a stock or ETF and the sale of one or more equity call contracts against it. So every option contract is the right to buy or sell 100 shares of stock. So if we own 100 shares of a security and we sell one call option against it, that would be known as the covered call strategy. So the long stock that we own collateralizes the short stock obligation by selling those shares. And the primary goal why we do this is to generate additional income over any dividends that our stock pays. So when we sell call premium, that call premium is ours to keep, whether we get assigned on our option or not. So that goes into our pocket, that it helps increase our returns. At the same time, by selling that call option, we are effectively lowering our cost basis on the shares. So it gives us a certain amount of downside protection, but while limited, it does give us some downside protection. This is a strategy that only works if we are neutral to this should say moderately bullish. If we are neutral to moderately bullish on the shares, this is a strategy that might work for us. So we're looking for a small price range over the strategy's lifetime. We're not looking for the shares to make a huge move to the upside or a huge move to the downside. If we are really bullish or extremely bearish on a particular stock, this is the wrong strategy to implement. So this only really works if our forecast on the shares is neutral to moderately bullish. It's very important. So let's take a look at the call writer's obligation. So option buyers have rights and option sellers have obligations. A buyer of an option has, in terms of a call, has the right to buy 100 shares of a particular stock on or before expiration at a specified strike price. The seller is obligated to sell those shares at the strike price if they get assigned. Assignment is your potential obligation. So it's possible at any time on or before expiration. So the majority of equity options are American style exercise. What that means is they can be exercised at any given time up until expiration. That is opposed to European style options, which can be only exercised at expiration. So an example of a European style option would be options on the SPX or the Russell or the NASDAQ, the big indexes that you see trading. Those are European style cash settled options. So for what we're going to talk about, we're going to be looking at American style options. So just keep in mind that options, American style options, can be exercised at any time on or before expiration. So in return for the obligation that we take on by selling that call, the call writer receives premium and gets to keep that option premium. That's the income we're looking to generate. So what's our profit and loss at expiration? Well, by selling those calls, we are limiting our upside potential. So we are capping our upside. So our maximum profit potential on this position, if we sell an out-of-the-money call, we take the strike price that we sold minus the price that we paid for the stock plus the call premium received. And if we get assigned on that stock and we have to sell our shares at the strike price, assignment essentially means that we make the maximum that we possibly could on that position. And we'll go through some examples going forward, but just keep that in mind. Once again, we will have a new break-even point by selling those calls, because if we take the stock price that we paid for the stock and we subtract the call premium that we received, we are actually lowering our cost basis on those shares. So every time that we sell covered calls and they expire worthless, we are effectively lowering our cost basis on those shares. The risk in this position is on to the downside. The risk is in the stock. So the call option that we sell offers us limited downside protection. So we're limited by the amount of premium that we take in by selling that call. So once again, our risk is below our new break-even price. So if all of a sudden, we sell some calls and we have a new break-even price on our stock and the stock goes below that break-even price, that's where our risk is. If stock makes a huge move to the downside, gaps down $10 or $20, that's our risk. It's owning the shares. Now, granted, most people are just long the market anyway without options, so that's always your risk. So by doing covered calls, you are effectively padding your downside somewhat, but you still have considerable stock risk at a certain point. But once again, this is a strategy we're only putting on if we are neutral to moderately bullish on the shares. All right, so let's take a look at an example. This is, we own 100 shares of XYZ. This is OIC's favorite fictitious company. If a company ever decides to go public and use XYZ as their trading symbol, we're in a lot of trouble because we have tons of content that we're going to have to redo. But until that time, we can use this example. So we own this fictitious company, XYZ, trading at $52 a share. So we are neutral to moderately bullish over the next few months, and we want to generate some additional income in a kind of a quiet market. And we have a target sale price for the stock. So we look 2 months out, and we see that we can sell the XYZ 60-day call at $1.75. So here is the P&L for this position. So we own shares at 52. We sell one 55 call at $1.75. So our maximum profit potential is $4.75. So how do we arrive at that? Well, if shares go from 52 to 55, we're going to make $3 on our stock. And at 55, if we get assigned, we have the right to sell shares at 55. We would make $3 on our stock, but we took in $1.75 for that option. So $3 plus $1.75, that's our maximum profit potential, $4.75. And you can see at 55, at $4.75, that's what our profit is. At $60, it's $4.75. If the shares go to 100, the maximum we can make on this position is $4.75. So once again, keep that in mind, that you are, in return for receiving income and call premium, you are capping your upside at a certain level, okay? So the maximum that we can make on this position, if we don't buy back our call, is $4.75. Likewise, on the downside, we give ourselves protection at by $1.75. So at 52, if the stock just trades at 52 and doesn't move anywhere, that $1.75 that we took in is ours to keep. That will actually lower our cost basis down to 50 and a quarter, because 52 minus 175 is 50 and a quarter, we will make $1.75. That's our profit potential. Below 50 and a quarter, that's where we start seeing losses. So at $50, we would lose $2 on our shares if we didn't have the covered call on, but we took in 175 by doing the covered call, so that offset our $2 loss. Our loss at 50 would be 25 cents. Now below 50 and a quarter, that's where you can see the downside really kicks in because our risk is in the long stock. So at 45, we would lose 5 and a quarter. At 40, we would lose 10 and a quarter, all the way down to 0. That's our risk is in the long stock position. So here is that same example in a graph form. So once again, this is just showing you the same thing. Our maximum profit potential is $4.75 to the upside. Our break even is 50 and a quarter. Just to keep in mind, if shares went from 52 to 55 and just sat there and our 55 call went out worthless, we would make our 475, but we would still be long the stock. That would represent a 9.1% return over 2 months. So you can do the math and annualize that, but this is where if you continue to do this over and over again, effectively you are lowering your cost basis every time you do that. When we sell that call at 175 and we lower our cost basis down to 50 and a quarter, that represents a 3.4% discount to where we originally bought our shares at 52. So that 3.4% discount, that's our protection. So down to 50 and a quarter, our new break even, that's where our losses would kick in if the stock went below 50 and a quarter. So these are some things to think about. When you sell options, you always have to be prepared for assignment. So these are not set it and forget it type strategies. These strategies require monitoring against early assignment, and sometimes people will close these out well before expiration. You don't necessarily have to carry these to expiration. Why would somebody exercise a call before expiration? The most popular reason why somebody would exercise a call before expiration is for a dividend. And this is something you should probably write down because this is really important, but there is a formula. So if the dividend that is about to be paid is greater than the time premium left in that call option, that option is a candidate to be exercised early. So let me say that again. If the dividend is to be paid is larger than the time premium left in that option is a candidate to be exercised early. So the only sure way to avoid assignment is to buy that option back. So let's go back to our old example where we're long shares at 52. We sold the 55 call for 175, but now let's say the stock's trading 65. So our option, we've made 475 because that's the maximum amount of profit we can make on our option, but our option hasn't been exercised. Okay, we're still short the option even though now it's $10 in the money. So that option has intrinsic value of $10, okay, the difference between 65 and 55. So at a minimum, that option is worth $10. Extrinsic value is the amount of value that option has over intrinsic value. So if that option is not going to be trading for $10, maybe it's trading for $10.10. Say it's got a week to go, it's deep in the money, so that option has $10 of intrinsic value and 10 cents of extrinsic value or time premium. And let's just say tomorrow that stock goes ex-dividend for 50 cents. Well, that 50 cents is greater than the 10 cents of time premium left in that option. That's why that option is a candidate for early exercise. So this happens, we get the calls from investors all the time saying, well, I put on this covered call and I was counting on receiving this dividend, and I woke up the next morning and I didn't have my dividend, and I had a bunch of cash in my account and my position's gone. Well, what happened was your call got exercised for the dividend, and you made the maximum you could on that position, but now you have a bunch of cash in your account and you're going to have to redeploy that somehow. So to avoid assignment risk, if you haven't been already assigned, is to buy back that option in the marketplace. So you could buy back that option before it goes ex-dividend and just be naked long the stock. You could buy back that option and roll that short option to a higher strike further out, take an additional time premium, and get the dividend when it gets paid. So you could always do that. But once again, this requires vigilance and monitoring. So be really careful having covered call strategies on when going into ex-dividend dates, especially when the dividends are particularly large. So the risks, once again, with the covered call strategy is in the long stock position. We already went over that. So the risk is below your new break-even price. So the covered call strategy offers you limited downside protection. It limits your upside potential, but that's something that you assume when you sell that call in the first place. Once again, remember, we are neutral to moderately bullish. We're not neutral to extremely bullish, because if we were extremely bullish, we wouldn't have the covered call on in the first place. And then lastly, strike choice is paramount and will determine how much premium you take in and where you would potentially sell that stock at a given time. So you have to consider that anytime you do a covered call strategy, you should probably only be doing covered call strategies on stocks that you wouldn't mind letting go at a certain price anyway, because that's always the risk. All right, so let's look at the second strategy. This is a great strategy. This is the cash secured put, and this is one of my favorite strategies. This strategy is say if an investor is sitting on a large amount of cash, maybe the market's made a quick move to the upside, you're not comfortable buying shares where the market is currently trading, but you'd be willing to buy shares on a pullback. This is where a cash secured put is going to be a great strategy to deploy. So essentially, it's a proxy for earning more money than otherwise earned in a CD or money market. So it involves selling an at-the-money or out-of-the-money put option. In this case, assignment is potentially welcome and desirable because by being assigned we're selling somebody the right. We sell a put, we're selling the right to sell shares. That owner of the put has the right to sell shares. By selling that put, we are obligated to buy shares from that person should the shares go south. It's possible that we could possibly buy shares below the current market price, and we'll have to set aside funds to securitize that in case that happens. So the risk, once again, if we do get assigned, is owning the shares. And, you know, our risk is if the shares go south after assignment, that is our risk in the stock or the ETF. But once again, we have the potential to earn additional income on funds that we do set aside. So here's an example of a cash secured put. So we have a stock, it's trading at $50 a share. Say the stock started at 40 and just 2 weeks ago it was at 40 and now it's at 50. And we're not comfortable buying the shares for $50 a share. But our outlook, we think over the next 60 days, there's a good chance that this stock could fall by 10% before returning to the current level or even higher. So we look out, we take 10% of 50, that's $5. So we look out on our options chain and we see that we can sell the 60-day 45 put for a price of $2 a share, or $2 an option. So basically we're selling the right to sell 100 shares of XYZ at $45. We're obligated to purchase 100 shares in case we get assigned at $45 a share. Keep in mind, we took in $2 to do this. So our effective break even, our effective entry price on the stock would not be $45, it would be $43. So we would have to set aside $4,300 per option contract to do this. Preferably, you'd be putting this into an interest-bearing security, but you would have to set aside money to guarantee the trade if potentially you got assigned. So you would lock up $4,300. You would generate the $2 in time premium. Essentially, a cash secured put is a way to get paid while you wait for the shares to to get back to a certain level. So this is the same graph using the example before. So once again, our break even is the strike price minus the premium. So 45 minus 2, which is 43. The maximum profit of $2 does not take into account resulting long stock positions should assignment occur. So one thing to think about in the strategy, just because shares go below 45 doesn't mean, there's no guarantee that you're going to get assigned on your puts. Let's say it's a week out and the shares, you're short this put and the shares go down to $42. And then over the next couple of days, they trade back up to 46. And we're approaching expiration and shares close at 46 on expiration. Well, those puts would go out worthless. You would keep the $2 that you sold those puts for, but you would not get assigned on your put. So if you really want to get in the stock, you might have to purchase the shares higher than 45 if you really want to get in to the stock. Granted, any price that you paid for the stock would be, you'd be getting at a $2 discount because you took in $2, but keep in mind that assignment isn't guaranteed. So there is a risk that you might not get assigned on your short put. If the stock closes below 45 on expiration, say it closes at 44.5 and you do nothing, you will get assigned on that put and you will own shares effectively at 45, well, let's call it 43 because you took in $2 for the put. That's when you would get assigned at expiration. So once again, just to reiterate what I've mentioned before, assignment is not guaranteed. So you may miss out on an opportunity to buy shares if the shares never dip. If the shares never trade below 45 and just stay above 45, you're going to pocket the $2. You're never going to get to buy the shares, but that might be okay for you as well. Actually, during the 80s, there's the Warren Buffett, who you all know, was famous for doing this in Coca-Cola. He would sell thousands and thousands of out-of-the-money puts in Coca-Cola, knowing full well that if the shares dipped at a certain strike price, certain level, he was more than comfortable buying additional shares to add to his portfolio. If the shares never traded that low and he didn't get assigned, well, he basically was creating income, and he was just goosing his portfolio. Those puts would go out worthless, and he would just pocket the premium. So, in a sense, you're selling insurance. You become the insurance company, and now you're selling insurance. And if those policies, if people don't make good on those policies, that the event never happens, then you just keep the premium. It's just another way to think about it. So once again, the risk in this position is if you do get assigned, and the risk is in the long stock position. So the risk is if not only shares dip, but they plummet. So there is potential for large losses should the stock go to zero. So keep that in mind. Your risk, should you get assigned, is in the long stock position. So the last strategy we're going to look at is the covered combination. And the covered combination is going to be easy to understand if you understand the two strategies we discussed earlier. So if you understand the covered call strategy and you understand the cash secured put, then the covered combo or combination strategy is going to be easy to understand, because all we're doing is we're combining those two strategies into one strategy. Oh, so just really quickly, Orville sent a question. I'll just answer this during the presentation. Good or bad for cash secured puts if the stock pays a dividend? Well, if the stock pays a dividend, due to something called put call parity, the price of a dividend should be incorporated in the calls and the puts. So it should be all factored. It really, it really doesn't matter. I mean, sure, if the stock goes ex dividend, it's going to drop by the amount of the dividend, but that should be priced into the option itself. So the price that you sold that option for should cover any dividend, especially if it's a potentially large dividend. That should be, put call parity allows that the pricing of calls and puts takes into account interest rates and dividends. So it's either way, it doesn't really matter whether your stock pays a dividend. It's not good or bad, so it doesn't really matter. You can certainly deploy this strategy on a stock that pays a dividend. So characteristics of the covered combination. So once again, we're combining the covered call strategy with the cash secured put. So now by doing this, we have the potential to buy shares on a pullback. At the same time, we have the potential to sell shares through the short call assignment. So either way, our objective should be met. So if the shares rally, we would sell our shares at a higher price, and if shares go south, we have the potential to buy additional shares on a pullback. All right, so once again, this goes over what I just said, but understanding the covered call and cash secured put, if you understand that, you'll understand the covered combo. In this instance, assignment is generally seen to be favorable, okay, because either way, assignment on the call or the put achieves our objective. Theta, or time decay, is our friend in this instance because not only are we selling one option, but we are selling two. So we're going to take an additional time premium. And every day as we get closer and closer to expiration, those options are going to decay in value. So as we get, it's not linear. So as we get closer and closer to expiration, those options decay at a greater and greater rate. So time decay, time as it decreases, becomes our friend. We do have limited reward, but that could be substantial if we take an additional time premium as well. And then once again, the risk is in the long stock position that we own, as well as the potential for adding additional shares should we get assigned on our short put. All right, so why does an investor put on a covered combo? So once again, it's for income. We're looking for a range-bound stock, and we are looking for shares to be somewhat trading in a range, and at the same time, we are looking to potentially buy shares on a pullback. So once again, our stock, XYZ, is trading $65 a share, and our outlook is for the shares to be range-bound between 60 and 70 over the next 6 weeks. So we look out at our options chain, and we see that 45 days out, we can sell the 70 level call for $1.50, and we can sell the 60 level put for $1.75. So that nets us a credit of $3.25, and we own shares at $65. So once again, this strategy is also known as a covered strangle strategy because we are effectively selling the out-of-the-money call and the out-of-the-money put, which is a strangle. So by buying 100 shares, it's the covered combo, covered strangle. It's just the same strategy. It's just by a different name. All right, so what is our maximum gain from this position? So if we look at the covered combo, our maximum gain is the call strike that we sold minus the stock price that we paid, 65, so that's $5, plus the amount of premium that we took in, which is $3.25. So the maximum profit potential on this position is $8.25, should we get assigned on our short calls. So whether stock goes to 70, 80, 200, it doesn't matter. The most we can make is $8.25. So we are capping, our profits to the upside are capped. So what is our maximum risk? Well, our maximum risk is the stock price that we paid for, $65, plus the potential for getting assigned on our short 60 put strike. So we would have to buy additional shares at $60 a share. So we take 65, add 60, we minus the net premium that we took in of $3.25. So that gets us to $121.75 or $12,175 for not 100 but 200 shares. So when you do the math and you divide 121 by 75, that gives us a new break even on 200 shares, and it's roughly $60.88. So that would be our break even on 200 shares. So our risk is any time the stock is below 60.88, that's where we're going to incur losses. So here is a graph of that same position. So it looks like a bow, and as you can see, our profits above 70 are capped. We start losing below 60.88, and then, you know, as the stock goes south, we really accumulate losses because we're long twice as many shares. So as you can see, the risk is really to the downside with this position. So what happens at expiration? Okay, well, at expiration, if we still have this position on and we do nothing below 60, our short call expires worthless. Our short put would get assigned, and we would have to purchase additional shares for $60 with the cash that we set aside. And once again, our new risk is the resulting long 200 shares that we would have in our account. So our risk is on 200 shares now, not 100 shares. When the stock is between 60 and 70 at expiration, well, this is the sweet spot. So now both the call and the put expire worthless. We are long stock from 65. We took in $3.25 in time premium. So we subtract that from the $65 that we originally paid for the stock. So our break even is $61.75. So depending on where the stock is at expiration will dictate, you know, if the stock is above $61.75, that's going to be our profit potential or our profit. And below $61.75 will show a net loss of some kind. So, and what happens finally at expiration with the stock above 70? Well, above 70, our short put expires worthless. The short call gets assigned, and we would lose our shares. We would end up making the net $8.25, the max profit. We would have a bunch of cash in our account, and we would have to redeploy it elsewhere. We could go back and buy the shares again, but you know, it all depends on, you know, what your forecast is going forward. Once again, you don't have to be married to expiration. Okay, many times traders will close out these positions before expiration. Let's just say the shares are between 60 and 70. We're a couple days out from expiration. You sold that strangle for $3.25. It might be trading for a quarter now. You could buy it back for a quarter. Okay, pocket $3, the net $3 in profit, belong the shares at 65, and now you can readdress it. You don't have assignment risk. Maybe you want to look to redeploy the covered call strategy. Maybe you want to deploy the cash secured put, or you want to combine them and do the covered combo. Once again, you got to it gets back to forecast and motivation. You want to look at how, if your forecast and motivation has changed, if it's the same and you're still neutral to moderately bullish, you might want to just redeploy the strategy and continue rolling it forward. So lastly, some things to think about. Very important. Once again, these strategies only work if we are neutral to moderately bullish, or if we are willing to buy shares below a certain price on a pullback. We're obviously looking to increase or add income to our portfolios in a quiet or flat market. The risk, once again, is in the stock position. So we have limited reward, but we have large risk to the downside should shares go south. Early assignment changes the risk reward profile, because if we get assigned either way, if we get assigned on our calls, we will make the maximum amount of profit on that strategy in terms of the covered combo. If we get assigned on our put, we are purchasing additional shares at a price that we are willing to re-enter the market for additional shares anyway. An increase in implied volatility does have a negative effect on this position, because we are short not just one option, but two options. So in the near term, you know, you sold that strangle for $3.25. It is possible that that strangle could, you know, if implied volatility goes higher, it could be worth more than you sold it for in the market. So near term, it's possible that you could have some losses on marks. but just keep in mind that implied volatility will have a negative effect on this position if it goes up. But on the flip side, if implied volatility goes down and gets crushed, that's actually going to benefit you because you're going to be short those options and they'll be worth less than what you sold them for. And finally, the passage of time has a positive effect on this position because we are short options. Theta is our friend and it's working in our favor. Every day as we get closer to expiration, those options are worth less and less, and we could potentially buy them back for less than we sold them for, and that is our profit. So that is today's presentation. Thank you for attending. For more information, you can always reach out to us at optionseducation.org, and that's our website. We have plenty of free online resources, options-related tools, options calculators, videos on various subjects from beginning to intermediate to advanced subjects. You can also reach out to us by contacting us at Investor Services at options@theocc.com with any and all of your options-related questions. We're there Monday through Friday from 8 a.m. to 4 p.m. Central Standard Time. And I also encourage you to check out our OIC YouTube channel, where we've archived many of our past live webinar events. That's a great resource because you can go to our channel, type in the search box, you can type in implied volatility if you want to learn more about implied volatility. And we've done multiple of videos on implied volatility. If you want to understand strangles or straddles or any kind of strategy you can think of or anything that has to do with options, whether it's the Greeks, time decay, you name it, we've done a video on it. So I certainly encourage you to check that out. And I thank you for spending time today learning about options. I will hand it back to Gina. I think we'll do, we have some time for Q&A if anybody has some options related questions. And thank you very much, everybody.
Okay. Thank you for attending the webinar today. And thank you, Ken. We appreciate your time on behalf of eOption. And someone asked if there are different strategies or tools that you can use to help screen for options. eOption does have a tool on our website called Options Play. So if you do go to eoption.com, you'll see on our web page resources, you'll see the Options Play tool. You can also check out eoption.com for other resources, as well as call our trade desk at any time. But we do partner with the OIC, and we do have content of OIC on our website. So feel free to check that out or call Ken at any time, or the OIC, as Ken gave the information. Feel free to call at any time. So we do appreciate your time today. And Ken, were there any questions that came in that you wanted to address or answer?
Well, I did want to mention, so the OIC does have on our website, we do have, including some options calculators, we have a volatility chart that it's free. It's a 1-year chart, so it is limited. And granted, it's on 20-minute delayed quotes, but you can put in a symbol and you can compare the 30-day implied versus the historical volatility of an option over the last year, and you can get a feel for, you know, how expensive or cheap those options are currently trading based on wherever the implied volatility is. So it certainly is a great resource. And like I said, you know, for anybody trading options, understanding implied volatility and historic volatility is crucial. Like I said, it's the most misunderstood aspect of options trading, and it's really going to just help you in terms of what strategies you want to deploy. Because, you know, when we have a high volatility market where option prices are expensive, there are strategies that are going to be better to put on rather than when we are in a low volatility market and option prices are inexpensive. So.
Okay, well, thank you again. Thank you for attending the webinar today, and we hope you found it informative.
There are some questions here. I'm sorry, I was looking at the questions and I didn't realize you could scroll down here. Let's see. Are there tools available to help good candidates for any of these methods? Okay, so yeah, once again, you know, it sounds like eOptions has some option screening tools. I'm not really familiar, Gina, with what you offer, but certainly you want to, you know, look at, you know, be familiar with volatility charts and where the implied volatility is to determine how cheap or expensive the options are that you're buying or selling are. Let's see, there's a question, how do you, on the covered put, how do you execute it? Well, you would have to set that up with your broker. You would essentially be selling a, you just have to set up with your broker ahead of time to make sure that you want to do a cash secured put rather than trading on margin, because it's going to be different. So when you deploy a cash secured put, you are selling that put, receiving the income, and then you are setting aside the difference between the strike price and the premium that you took in as to collateralize that obligation that you sold. But once again, I would speak to your broker to make sure that you are trading it as a cash secured put and not in a margin account. And I think, looking at some other questions, I don't see any other questions. Once again, you know, if anybody has a question that comes to mind after this webinar, you can certainly send us an email at options@theocc.com. Like I said, the turnaround on getting an answer is fairly quick. You know, we're happy to answer questions regarding this webinar or any options related questions whatsoever that you have. Please use that resource and take advantage of that. And that's about it, I think. Gina?
Thank you to everyone for their attendance, and on behalf of eOption, we want to thank Ken. We want to thank you for attending as well. And again, check out eOption.com, and you can feel free to check out our website or call our trade desk, and we're happy to answer any questions that you have as well about option strategies or trading strategies. Thank you again.
Thank you, everybody.